What's up you guys, this is Chris for Hustle and Bustle. Today we're going to continue with comparing real estate to the ATM business. Just a quick note before you smash the like button, kidding, smash the like button and continue listening. I already had a couple of comments from my first video, and please stop being that stupid. Stop reading a title of a video or a title of a column or of some article online and assume you know the whole story. Let's see what I got here, just to... No one saw that. One smart guy says, one needs a lot of cash versus one needs little cash. Define a lot and little, because you need 5K for one ATM, as we saw. Is that a lot? And also with one ATM, what are you going to do, become rich all of a sudden with the $200 a month that you're pulling? Then is 50K is a lot of cash. That's why I'm comparing in this video 50K for ATMs or 50K for a real estate. So please watch the video and stop embarrassing yourself and giving an opinion on just looking at the title. Next guy comparing two different animals. So that's true. Every business is different. I have 10 of them. Trust me, I know what I'm talking about. Every business is different, but they're all comparable to a certain metric. And with this metric, you can actually think, oh, this business is better for me because I want more cash flow, or this business is better for me because I want more appreciation, or this business is more sourceable, or this business is more what have you. So with all that said, continue watching. Now we're gonna get to the cash flow and to the appreciation, to the tax deferral, so more interesting stuff, at least for me. And please stop being stupid and thinking that you know everything just by reading a title, okay? Thanks, enjoy the video. Now let's go to the cash flow aspect of it. So in my opinion, again, ATMs are purely only cash flow. There's really nothing else to it. It's only cash flow. Because my next segment is appreciation, and there's no really appreciation. Actually, ATMs depreciate. The account that you have itself doesn't really appreciate. It makes what it makes. So let's take this example with 100 transactions a month, which to me is not a great example because we're looking at the top of the transactions that you want to make a month. Not every account makes 100. Most accounts actually do not make 100 in my experience, in my opinion. Again, some maybe make 2 and 3, but like I said, those are very hard to get. If you happen to get one, that's great. I personally don't have one. So let's say you make 100 transactions a month, $2 each, because that's what's left for you. What am I calculating? 100 times 2 is 200. So you're making $200 a month from that ATM. Now that does not come with no expenses. Obviously you have cost of cash. If you get a vaulter, you're gonna get $1 less. If you put your cash yourself, this is also cost of cash because you are missing on the opportunity to buy anything else without cash. If you have 10 ATMs, which we're going to get that example, 10 ATMs, you're making $2,000 a month. But if you put $3,000 in each, that's 30 grand that you can use for anything else, but you can't because they're locked up inside a machine. You can buy stocks, you can buy a house, you can buy anything that will net you more money. Whatever the case is, whatever you're into, you can buy it, but now you can't. So 30K are locked in. So you got that cost of cash, which how you calculate it, it's your business. But if we calculate it with a vaulter and you make 1,000 transactions for all 10 accounts, this will be $1,000 less a month. So from the $2,000 cash flow that you're making, now you're making 1,000. But now you eliminate the work, right? You don't need to go to the account, which is also work. It's gas, going to the bank. There's a risks with that because you might get robbed, or you're carrying a lot of money. Maybe something will happen one day. There's a risk there. See, when I'm going to my real estate, I'm not gonna get robbed because I'm not carrying any money on my, to my real estate, nor when I'm closing on a property. All I'm saying is the cash flow is there on 10 ATMs. Let's take the average. Let's say half of the machines you're gonna vault, half of the machines somebody else will vault for you. Or maybe now you're doing it yourself, but in the future somebody else will do it. So instead of $2,000 cash flow, let's make it $1,500 a month of cash flow. On the appreciation side on the ATMs, there's no appreciations actually. ATMs depreciate with 20% a year, at least according to their schedule. They lose 20% of their value each year because they're on a 5-year schedule. Now, of course, you're not going to use the ATM for only 5 years. If it doesn't break, you'll use it for 7, maybe 10. So I'm not sure what number to take here. Maybe 8 years is a good amount that we're going to take, that every 8 years you have to change your ATM. I mean, that's considering nothing else comes as a law that you have to add on. Like before, we didn't have chips, now we have to add the chip card reader. But there's no appreciation, it's only depreciation. On the house, however, on the house side of the things, on the real estate side of things, appreciation is about 7% or 8% a year, depending on what property you buy. High-end properties appreciate more, low-end properties appreciate less. I talk about this in my other videos. But the cash flow, it is not $1,500 a month, obviously. Say you buy a $235,000 or $250,000 property, the rent is about, say, $2,000, 1% or a little bit less than 1%. I think that's fair thing to say. But your mortgage will be, okay, here I'm showing that your mortgage will be $1,100 and change. Let's say it's going to be $1,300, your mortgage, and that's including timber. If you've seen my other videos, you know that's taxes, insurance, management, maintenance, emergencies and reserves, basically everything. Your mortgage plus some reserves, plus the escrow, everything. Say it's $1,300 for this property. Remember, we can only get one property and 10 ATMs. So the cash flow will be $700. You know what? Let's make it easier. Let's make the cash flow $750 and all the payments towards the house $1,250. So we can say that the ATM makes twice as much cash flow as the real estate property. Now, obviously the real estate will appreciate in the next 8 to 10 years, right? Compared to the ATM business, maybe a few of your good locations, actually the good locations most likely will not gonna close unless they're become illegal, like some of those game rooms became. But some locations might close, like the barber shops that I'm making 100 transactions in. Maybe they'll close in the future, so I need to relocate. Maybe I'm going to have vacancy. Maybe the ATM is going to stay at home for 2 weeks until I find a new account. But let's call that break even, because there's some vacancies into the real estate market, although now there's really not any vacancies. Let's go to tax deferral. Now, by the way, when you make $1,500 from your ATM a month, you don't think you're making all the $1,500 and put in your pocket, right? Because you got to pay taxes, and they're about 30% if you have a LLC. So from that $1,500, take 5 and give it to Uncle Sam. So now you're left with $1,000 in cash flow. Now, obviously you can depreciate 20% a year. We're gonna go to that example, but from the $50,000 you spend for ATMs, 20%, which is 10K, you get to depreciate every year. But after those 5 years, when the ATMs are fully depreciated, there's nothing else to depreciate. Maybe you can depreciate mileage and gas, but you can do the same thing when you're doing real estate. So that's a wash. We're not gonna look into that. So after 5 years, you will have to pay all the taxes on all the money that you collect from your ATMs. Now, for the first 5 years, you're gonna pay taxes, or 30%, only on the money only on the money that you make over $10,000. So if we're making 15K, sorry. So if we're making $1,500 a month from an ATM, that's $18,000 a year. So on $8,000 times 0.3, so you're going to be paying $2,400 a year in taxes. So you're looking at rough 13% taxes on the whole 18K that you make for the year. Now in real estate, however, on that $750 cash flow that you're making, which is $9,000 a year, you're not paying any taxes, because I've explained in other videos, or maybe I will explain in other videos as well, your property depreciates on paper for 26.5 years. So if your property is $250,000, the property depreciates with $9,433 every year, but you're only making $9,000. So you actually get to minus extra $400. Not only you're not paying any taxes on the $9,000, but you actually, the extra $400, you get to write off your personal taxes that you lost $400 extra. So you don't pay anything for at least for the next 26.5 years. So tax deferral, ATMs are not great for tax deferral. Almost last point, outsourceability. How easy for us is to outsource this process of voting the cash. It's pretty easy. It's very easy to outsource it. It's a couple of phone calls away. Houses, how easy is to outsource the management, the maintenance on the property? It's pretty easy. it's one phone call away or a couple phone calls away until you find a good managing company. So both of them are outsourceable. That's going to minimize vacancy. Compared to ATMs, when somebody votes for cash and that company closes, you cannot account for vacancy. You need to find a new spot. You need to find a new account, or you can pay somebody like a locator. They charge between $15 and $1,500. I have a video right here for what I think about that. So basically, the vacancy you're going to be responsible for. Whether in real estate, the more vacancy there is on the property, the managing company does not make money. They do not want to have single day of vacancy. All right, and finally, if you're still here and you're still watching, let's go to the example. Subscribe though in the meantime. So 10 ATMs, that's 50K, and they make $1,500 a month, so that's $18,000 a year. And we're gonna pay every year, we're gonna pay $2,400 in taxes. So that leaves us with $15,600 a year for the first 5 years. So we're gonna multiply that by 5, and we're gonna make $78,000 for the first 5 years, and then we're gonna make $90,000 for the next 5 years. So we're gonna make it 10 years. Let's say in 10 years we need to replace the ATMs. Let's give them a little bit more longevity. Now in the meantime, you're gonna have expenses on the ATMs, but you're gonna have expense on the house as well. But it's all a write-off. So $168,000 in cash flow, and if in 10 years, if we decide to stop with the business, there's nothing we can do. We can't really sell those ATMs. They're old. I don't know if someone's gonna buy them. There's not really much to do here. Okay, 168. Now with the property, we can buy one. I'm gonna be making $750 a year. We're not gonna be paying any taxes on it. 750 times 12, that's $9,000 of cash flow. That is 9,000 is 9,000 of cash flow. When we run that by 10 years, that's going to be $90,000 for 10 years. So as you can see, we make more cash flow with the ATM business and way less cash flow. It's not half, but it's close to half less from the real estate, which is normal. We make twice as much cash flow a month from the ATM. But so I put here 7.5% appreciation. It should be more. It should be about 9, but let's see 7.5. You guys are looking at, if the starting value of the property is 250 and appreciation rate is 7.5% for 10 years, your property is now worth $5,000 and $1,500. So you tell me which one's better. Also, you don't owe $250 on the mortgage anymore. You owe way less, because you remember we put down 50K. That means we started with a loan of 200,000 and we've been paying $1,250. I play with the property taxes a year here because I just wanted to make the payment $1,250. So in 10 years, so we have a balance of $150,000. So that means that we owe $150,000 and the property is worth $500,000. So that's $350,000 we can cash out in equity. And there's two ways. You can do a 1031 deferral exchange, which I have, or I will have actually videos in the future, or you can just cash out the money and pay long-term capital gains tax. But even if you pay 50% capital gains tax, that's not the tax. Okay, I'm obviously joking here. You will not pay 50% capital gains tax. This is how the capital gains tax rate is, as I'm showing on this picture. So in this scenario, we're going to fall under the 15% capital gains tax, and our profit is 350,000 times 0.15. We're going to pay 52,500 in capital gains tax if we want to do that. So roughly we're cashing out $300,000 for the 10 years of this property being ours and from the appreciation, plus the $90,000. So we're getting $390,000 after taxes. Now there's another way you can do other things as well. You can, instead of cashing it out, like I said, 1031 defer it, or you can just put another mortgage on it and pull more equity out, because in America we do not pay taxes on money that are not income. And if we do refinance on this property, we're gonna take more debt, not more income. So that's another option, but that's a topic for another video. So at the end of the day, you decide what you want to do and you decide what business is better for you. But to tell me that the ATM business is so much more amazing than real estate, like there were a few comments in some of the groups on Facebook, that's just ludicrous. You need to take into account a lot of other things, and maybe in this video I did not take into account absolutely everything. Not to mention that if I give you a crazier example that you can own 3 houses each year for the next 10 years with the same $50,000 that you started with, that's 30 houses that you have, and the appreciation hits all of them. You have 30 houses appreciating. And I'm not saying that real estate is the best, but numbers are numbers and they don't lie, unless I forgot to take into account something else. And if I did, please leave it in the comments below. Okay guys, that video was way longer than I anticipated, but I hope it provided value and in-depth look into the ATM business compared to the real estate business. And with that said, keep hustling and I'll see you next time.